my general rubric is I'm looking for cash on cash return. For every dollar that I put in, I am trying to get that dollar, not adjusted for inflation, back in 18 months.
Hello, everyone, and welcome to the 13th episode of Colors of Web3 Entrepreneurship. My name is Lam. I'm your host today, the Web3 guy. But today we'll be taking a quick break from Web3 to talk to LaSean, who is the founder and CEO of CAGR.com, which is a private equity firm. I think, LaSean, can you quickly introduce about yourself?
Hey there. First off, thanks for having me. Great to hang out today. I am a person who's had a windy road, and so I don't get too hung up on the titles. But currently, I invest full time, and that allows me the opportunity to discover all sorts of interesting opportunities, meet different people, travel to different parts of the world. And so we can take this conversation not just around entrepreneurship, but how you can kind of use the observations you find in the world to identify new opportunities.
Awesome. Before we dive into your startup, I'll probably quickly talk about yourself first. I just want to get to know you better, and also for the audience to get to know you better. Can you quickly maybe share with us your upbringing? Feel free to choose whatever timeline you think appropriate, from maybe your education leading up to your professional work experience, maybe.
Sure. So I started as a self-taught developer, and once I got to college, this was kind of in high school era, and once I got to college, I was like, oh my goodness, I didn't know somebody could actually get paid to write code. Like, that was how naive I was. I thought it was just something people did as a hobby, and my career has largely been the intersection of something related to software, largely applications, and media production, leveraging or incorporating media inside of software. And so I've had a very windy road, a lot of different jobs in these industries. So I started as a software developer. I moved to a role called user experience design, UXD, moved after business school to roles around product strategy and product management, and eventually kind of start managing teams that had all of those elements together: data scientists, software engineers, PMs, designers, kind of cross-functional teams, kind of building software. And worked at really big tech companies, some of the biggest in the world, as well as the some really tiny companies. I've started 4 businesses myself. 2 of them have failed horribly. I don't look at those as failures, though. They just were expensive tuition. One of them was an acqui-hire, and then one I sold. And again, the common thread for all of those is either I've shown up at a point of an industry where I thought there was some inflection point that was either reshaping behavior, or there was some new technology, or there was some compliance or law that had changed. And I really think when you find those systemic changes, there is more opportunity for you to learn and not get it right all of the time and still find success. And so whether it is something that's very cutting edge technically, or it's a maybe a known category, but you're going into maybe a new geographic market, I really get energized by taking the path that is somewhat unknown, and I found pretty good success doing that. And so when I decided to invest full time, it was actually a challenge to kind of my traditional approach, where I don't currently focus on or invest in the most cutting edge technology unless there is a clear articulation of who is this market, and how are we going to sell it. And I find sometimes in the past I was drawn to something that was interesting from a technology standpoint, but I didn't really do the work to make sure there was a market, and to make sure I did understand how kind of go-to-market activities to sell and market that product would work. And just as a quick aside, I use the definition, when I say the market, what do I mean? I'm just really talking about who's the customer. And the definition I like to use is a market is a set of individuals who share a problem that is painful, urgent, and reoccurring. And semicolon, they have the means to actually pay to solve that problem. And when you can code or you can do some of these other things where you can just hop in and start solving the problem, sometimes, at least for me, I got lazy during that process and I start building something before I validated, if people actually wanted it. And that's really a huge part of my process now and how I invest, whether it is products that I'm incubating or products that I'm acquiring or investing in. I really try to understand, does the operator or the team leading this deeply understand their market? Is there a quality market? And do they understand the right rhythm for their sales and marketing? And, it could be a high touch funnel where they're selling stuff. It could be a low touch funnel where there's a viral loop. I don't really care how that flows. But as you kind of hear in my journey, I've just been kind of stopping at different places, learning things, and like creating a custom toolkit. And I can't say that my toolkit will work for everyone, but I am a very systems-based thinker, and I think the result of that is a system that is pretty durable to different types of businesses that I assess. And so maybe we can get into some of the process considerations there.
Awesome. Yeah, and actually, I would like to know more a bit about. You said you started 4 businesses, right?
Yeah.
In your lifetime so far, and can you tell me, did you begin those while you were still working in big tech firms, or did you take a break from the corporate world and then begin those companies? Maybe share with us a bit about that.
Yeah, so the first one, and I've worked at 2 other startups too that I did not found. I learned a ton at those as well. But for the four companies, the first was effectively a productized agency. I was taking a set of standard services, and it's an interesting thread. Maybe we'll come back to that. That I still really believe in, and I just didn't execute and hire the right talent, and so it imploded pretty quickly. The second was a retail business. This had nothing to do with technology. I'm a person who spent so much time there, and I attempted to start a salad business. And so I
Sounds
didn't.
yummy.
Yeah. And
Yeah.
so the menu was actually quite fantastic, but it was very complicated. And what I told myself was, I'm going to have the best brand. We're going to have a great tech stack. All of the loyalty programs and the ordering is going to be seamless, and the supply chain in the back end is all going to be, very efficient. And so I had all of those pieces, and for the most part, those got executed properly. But I picked the wrong market, i.e., the wrong location. And two, I grossly underestimated the overhead emotionally for dealing with a product that had so much kind of forecasting baked into the operational model. Like, lettuce goes bad, salad dressing goes bad, like these things go bad. People aren't available for work. And so there are a lot of interesting things that I learned from that role that if you told me going in, what was I going to learn from running a salad shop that helps me make better software? I was like, those aren't related. I thought this was just going to be an easy business. And so for those two, I attempted them while I was working another job. The third one was a SMS platform that would connect messaging to big stadium boards. And so if a stadium or a brand wanted to run a campaign in stadium, like a basketball stadium, soccer stadium, baseball stadium, they could get participation from the audience, and get them to say, guess, which of these color, cars are going to win the next race, or who do you think is going to get the next touchdown, or whatever the piece was. And then there would actually be prizes, and we would do coordinated giveaways. And the flip side of that is whoever paid for that sponsorship or that campaign in stadium, they got access to all those phone numbers, so they could retarget those customers, in other ways. So it's quite valuable. That didn't get to any escape velocity, but that wasn't an acqui-hire, and so we sold that to another company, and that was a good lesson learned. And then the one exit was a mobile app company, and it will sound kind of silly today because this was a while ago that I started and sold this company.
What year was it?
This was 2011, so this is about 12 years ago. And the insight I had was, think 2011, we were 4 years into the iPhone, and I had been working in mobile for quite a while. And every time I was trying to get access to any kind of meaningful data on the business side, there weren't a good set of APIs. And so today, for maybe some of the technical folks in the audience, there's all sorts of services that do extract, transact load, and all these ETL workloads. They would take data from one place and go move them to some other place, and that transform stage, maybe take it and put it in a different format. But back then, like, this didn't exist. And so the unique insight I found was there were businesses that wanted to enable their mobile workforce. A lot of times it was sales teams, to get access to like SAP data or like these big enterprise workloads. And they didn't have a safe, secure way to go connect that. And so we basically built a reusable set of tools to do a proxy layer from those backends to an API that the phone app could build. And then we just had a bunch of reusable UI components. And so we could roll these apps out very quickly. And they were used for things like, a big semiconductor company, for example, used it to check if there was real-time inventory of their chips, and they could use that when they were going into a meeting. And so back then it was very transformative because it was really real-time information that no one had back then. And there wasn't even mobile web or responsive websites that could really solve this problem. But the real punchline there was not so much the tech. The reason I was able to sell that company is we secured a couple of contracts to some large name companies, and other people started competing in our space. And they're like, how does this little small company with 16 people have the exclusive contract with these, large players? And so they decided to just kind of take us out, and it worked out well for me. It wasn't, it was transformative money, but also I learned a ton about the deal process. I didn't have the best tax optimization strategy. There's all sorts of things that I'm like, oh, had I known what I know now, I would have done that deal a lot differently. But it gave me liquidity. It gave me a lot of freedom. And over the years, I've experimented with some of the cash that I got out of that deal to invest in different things. I've done spec homes. I've done real estate deals. I've I've invested in feature films. I've done over 30 angel deals. And so I've tasted the buffet of all these asset classes. And what I found is, for me, I don't like to get too far removed from the actual making of the product. And so I'm drawn to things that are going to naturally have smaller execution teams, because I want to know the humans and I want to understand the product. Some people want the opposite of that. They want to scale as fast as possible. They want it to be as passive as possible. I'm a very active operator. And so for me, a good day is when I'm learning something new, or people are educating me on an old idea that I need to change my mind on because I'm kind of still in the game, still in the mix. And so that's kind of the journey, so far. And I've just been leveraging those lessons along the way to help me, source better deal flow and hopefully find, better companies to invest in.
Awesome. No, thank you. That's quite impressive, I think. So before we dive into your current company, maybe can you share with us what do you do for fun? What are your hobbies?
Yeah, so I live in the Pacific Northwest here in Seattle, and while I'm not an extreme outdoor enthusiast, I'm fascinated by the lifestyle of the outdoor enthusiast. So, you won't catch me, sleeping in the wilderness for 4 days or anything like that. But I love all the activities around kind of getting outside. And it's good contrast from, the time we spend on the computer. The other piece, and sometimes, I think that society wants us not to say this out loud, but I love consuming media. I'm not much of a social media person, but long form content, movies and television, I really love to deconstruct story. And so I spend a fair amount of my free time, with my girlfriend, just watching different shows, cheap shows, high budget shows, genres that are unexpected. And I'm always just trying to see, what was the flow, the process paired with the kind of emotive hook that got me to say, oh, this got a reaction out of me. And so much of storytelling is kind of connected to psychology. And so we can use a lot of that, back in business. And so I consume a lot of media. You can, see in my background, I also have a lot of books.
Mm.
And books are really important to me because, I like to tell folks, you can go hire a coach. I'm actually a big fan of coaches,
Hmm.
but you
Yeah.
probably want to feel some pain first. So you know what questions to ask. You don't want to ask them the basic questions. That's a
Mm.
very expensive way to get those basic questions answered.
That's
And
true. That
books
makes sense.
are, many times, especially if it's a tried and true book that's been around for,
Hmm.
years or decades, it's 20 years of someone's expertise that
Yeah.
you can buy for 8 hours of your time and $20. And I'm like, that is like one of the best deals in coaching going. And so I really feel that I can stretch my mind and find new opportunities when I consume concepts from others, even if I don't agree. If you look at my YouTube stream or
Mm.
what have you, you're like, there's a lot of like opposing faces on this. And my goal is like, I want to be dialectic. I want to like be able to argue the other side and then ask myself from, more first principles, am I really picking this position because it's convenient, it's comfortable, I have some bias, or do I really think this is the right position? And so I love the idea that I can have, that saying, um, strong conviction loosely held. If I find new information, I give myself permission to change my mind. And so part of my media diet is also kind of challenging myself.
Okay, nice. Yeah, I seen you have a lot of books over there. Is there any particular categories behind that, or any you read pretty much
They're grouped
everything?
all sorts of ways. There's an architecture
Mm.
section. There is a kind of a core business section. There is coding and programming books. But the ones at the top are largely art books, and
Mm.
that's probably what I have the most of. And these are largely, movies or other types of creative where someone's kind of assembled all of the pre-production art. And I'm just really fascinated by that process of how you make things. If you go to my Instagram, I don't have, much of a, like, I don't use it for business. And mostly it's
Mm.
just me experimenting with generative AI for image generation. And I'm just so fascinated how quickly it's moving. If you go deep into that, you'll see, kind of the NFT phase that I went through. And I still believe there's some combination of all these things that we haven't quite sorted out or figured out. And so I'm bullish on the macro trend, and then I try to kind of use the tools in a more hands-on way, so I keep learning. And I'm really excited for 2024 because if you look at Runway and Stable Diffusion video and some of these other models that are showing the early stages of what you can do with video, I think 2024 is going to be the breakout year. If you look at something like Midjourney 4 or 5, where it really changed, like the quality was demonstrably better. I think towards the tail end of 2024 we're going to have that moment for video, and that really is going to be something I think that challenges all sorts of things, not just Gen AI, very practically in it from a niche standpoint, but it's going to challenge media production, how we think about the economics of film, television, publishing, and to a certain point maybe how we think about celebrity culture. A lot of leverage we get in business today is because people follow celebrities, they trust their recommendations, and they're able to turn that trust into some type of economic exchange. And so one of the themes that I research at the end of each quarter, I like to research the list of things that I'm going to go deep on the next year. And one of those is virtual creators. And I'm really interested in understanding how virtual creators are going to surface. And I think the reason I'm so bullish on this is because when I have
Mm.
conversations with people, experts technically, or just friends and family who don't really pay attention to this space, it's hyper polarizing. And anytime I see that level of polarization where some people are like, oh, that makes total sense, I would love to do that, I would like it to
Mm.
be customized to me, and then other people are like, I would never do that, like that sounds like the craziest idea. When I hear that extreme polarization, I know there's a product somewhere in that. And so I'm really bullish on what's going to happen with video and some of these generative AI models,
Mm.
because I think it's going to unlock some of that disruption.
When you said virtual creators, are you referring to like an alternative, I don't know, identity image of someone or something, like a robot version of person?
Let's think you and I get into a room and we say we're going to dream up a new universe. and we're going to have
Yeah.
a set of creators that never existed. So, if you look at the history of this in South Korea, there have been what folks would traditionally call virtual creators there, and this would be people who are syncing themselves to some type of 3D rig or a 2D kind of animated rig. And it's kind of an anime kind of cutesy look. And maybe they have like a
Okay.
voice changer on, and
Mm.
they're live streaming or creating YouTube videos with a different personality. And
Got
I
it.
think that's like the historical step on where this started. And if
Yeah.
you see how the technical tools are coming together, we're going to be quickly in a place where, 2, 3, 4 people. I don't know if we're quite there for one person, but a very, very small team, single digit numbers, are going to be able to make feature films, publish books, and do different things. And the idea that you would cast a famous person to star in the film, I'm not sure if that's where we end up. I think there'll be a whole new class of Mickey Mouse and
Mm.
Hello Kitty and other types of characters, and they probably won't have global appeal. There'll probably be like hyper niche, but that will be okay because you could create 10 or 50 of those properties. And what I really find fascinating about media, this is a bit of a side, but it kind of speaks to how I think about, kind of exploring opportunities. If you look at the most profitable and the highest grossing media franchises of all time, top 20, top 50, you'll see some usual suspects on there. Like, it's not surprising that um, Star Wars is on that list, but it's not number one. I think it's barely in the top 10. And merch is a large portion of why that's even why it's even on the list. But if you take all the different transmedia points, books, TV shows, movies, merchandise, what have you, live out of home experiences, the number one on that list is Hello Kitty. And it's crazy, right? Mickey Mouse isn't even, I think it might be third or fourth, but there's others you might not
Interesting.
expect. Winnie the Pooh is in the top 10.
Yeah.
And what's fascinating is almost all of these like hyper high grossing entities are animations, illustrations, or other kind of non-human characters. And I believe the reason that is the case is we as humans, we get all this nostalgia baked into these, and when that nostalgia kind of crosses generational lines, the owners of that IP can reboot that with the latest technology, but still call back those same stories. And it's a lot harder to do that with a live action cast. They get old, and it's like, how many times are they going to make Fast and Furious? I was on the
Yeah.
Fast and Furious train for a long time. I think they're at 10 or so.
Yeah.
And
It's been a
like in
while.
the last one where they like the cars went into space, I'm like, okay, I think you all have jumped the shark. This is a little too wild. But my point is, the world has already told us that they have these deep connections to these fake characters. It's just
Mm.
been very expensive to go do this. If you look at Pixar, I have a background in 3D media, and Pixar back in the day, let's say the last decade or so, something like Coco, I believe that was around $850,000 USD per minute. Like, that's the cost to promote to produce, not the cost
Yeah.
um,
Wow.
to market. That's crazy number, right? And
That's
so,
expensive. Yeah.
yeah, and so imagine that number falling to, $1,000, $500 a minute. Like, it's just going to reshape the economics. So anyway, I kind of got in a tangent because I get really energized about some of these themes. But what I'm really excited about is, how a smaller group of people can create outside leverage, through media and code, using some of these new tools.
Yeah, super interesting point you raise it. I live in Japan, and I've actually seen some of these virtual creators the way you describe them. Hatsune
Yeah,
Miku is probably one of the popular one, and I
yeah,
mean,
some of them
Hello
are
Kitty
very
is from
popular.
Hello Kitty is from Japan, right?
Yes, yes.
Originally, yeah, and also lately I've seen some other country creating their own virtual idols as well. So yeah, so I'd be interesting to see how it pan out in the future. But
Yeah.
anyway, without further ado, let's go ahead and jump into your current company, CAGR Investment.
Yeah.
Feel free to share any slide or presentation you have, or you can talk over them. Yeah.
All right. I'm going to pull up another chart here before we do this.
Okay,
Well, I'm
sure.
glad I did this because I'm going to correct myself. I don't want to give bad information. I was going to go pull up the The highest grossing
I'm
franchise. It's
yeah.
actually not Hello Kitty. Hello Kitty is number 2.
Okay.
Here we go. It will hopefully show up here in a moment.
Sure.
Looks like it's trying to share. Now we have some anticipation built into the refresh. Maybe I will stop. Oh, there we go.
Yeah, I see. Yeah. Pokemon. Okay.
Pokemon
Hello
at number
Kitty.
1.
Nice.
Hello Kitty, Winnie the Pooh, Mickey Mouse is 4, Star Wars.
Interesting.
I mean, you see this list.
So this is a value of the brand, right? I guess, right?
Yeah. This is just actual grossing dollars, right? So it doesn't speak
okay.
to profitability. But what I like about this is it's not a fake, goodwill intangible number. This is just actual dollars. But when you look at this, it's very few live action franchises on this list, and some of them have crossed, right? So Star Wars, there's a dancing on ice Disney princess. We got Mario now has live action, Harry Potter. So we have to get all the way down to Marvel, Spider-Man, and some of these others where the numbers are very different. And even this is interesting. You can see these sliders. There's a color piece here on box office or merchandise. How much Spider-Man is almost matching the gross of Marvel, and a large part of it is because it's just sold so much merchandise. People love Spider-Man as a merch thing. So you look at this, and I'm just really fascinated on how people spend their disposable minutes, and this is a good proxy of how time and nostalgia gets translated into dollars. And so I think it's a cool visual.
Yeah, very interesting. Thanks for sharing.
Yeah, so I'm going to switch over to a little bit about my business. I'll go through this quickly, and you can do a callback. But the focus of what I do is investing with permanent capital. And so instead of investing for the short term, I am trying to acquire or incubate businesses that I never need to sell. And it doesn't mean I will never sell them, but it means they are structured in a way that it makes sense to invest in the company if there is never a liquidation event. So it doesn't need to go IPO. It doesn't need to get acquired for the business to make sense. And the whole premise or thesis that I run is to do this efficiently, you need to have audience building and you need to have automation first thinking built into your flow. I have a single success metric. All the other vanity metrics to me don't matter. It's just FCF, free cash flow. And it's a very easy way for me to normalize how I think about things. I won't spend too much time on this here on the screen, but if you kind of think about where different deals sit, there are public companies, there are high growth private companies, and then there are cash flow centric companies. And across the board, you're going to hear those terms of kind of the hedge fund, the private equity, and the VC funds. Where I sit is the very smallest of those private equity deals. And even though here on the number, there's it's 5 to 50 million, I've done deals smaller than that. And so for me, what is magic is, can you buy cash flow? And then, I do the common DCF discount, cash flow analysis and all those things. But even more like simplistic, it's like, can you find an asset where someone needs the money now for whatever reason? Life stage, they need money for another business, they're emotionally tired of running the business. So like whatever the reason is, that you can buy future cash. And with so many shenanigans in the world on how people make money, I just like the simplicity of the business worked or it didn't work based upon how much cash that it was able to spit off. Go ahead.
Regarding this, actually, can you go back to the previous slide, private equity? I think it would be good to give a simple definition of what is private equity, for people who may be listening.
Yeah, that's a great point.
Yeah.
So why don't I break up these three? And there are a few adjacent other pieces that aren't here. And largely these are going to be different asset classes. A lot of times, people understand stocks, bonds, cash equivalents. And so those are the basics. But if you look at a deeper list, let's say you were a high net worth individual and you went to like a Goldman Sachs and they were going to help manage your money. They're going to have a portfolio approach that they're going to pitch. It doesn't mean it's a good idea, but they're going to pitch you on this that says, okay, what you need is to diversify your income. You're going to want to have some public equities. Let's say for me here in the States, I might want to have index funds the NASDAQ or the S&P 500 or what have you. And maybe there's a handful of individual stocks. I personally don't try to outsmart the market, so I keep my stocks very simple. But so the hedge funds are managing those assets. Then on the VC side of things, they are investing in early stage, high risk startups that are trying to grow very quickly. And so those are the pieces there. And what's powerful, I think, about the simplicity of this table is you can see for the public companies, you have these two ends of the hedge fund and the retail trader. And then on the private company for startups, you have angels, angel syndicates, you have super angels. Eventually you get to kind of VC firms. You have small VC firms that manage maybe 50 to 150 million. And then you have massive firms like, Andreessen Horowitz that have billions of assets under management, AUM. Yeah. So it's helpful to have those bookends. And I'm simplifying because these are the biggest pieces, but there are other asset classes like collectibles. So art is many times a column on these types of tables for high net worth individuals. And they're going to say, hey, do you want to acquire a Picasso or what have you? And once I learned how cash moved around with collectibles and high-end art, it was one of the reasons why I was like, okay, maybe the initial wave of NFTs wasn't the right fit for the mass market. But I think from a behavioral standpoint, there's enough history that shows that if we can get the right technology and interaction model in place, NFTs will be a thing in some way, right? And so I'm just very bullish on these other pieces. But those are the kind of the area that these are swimming. Getting to established private companies, established is a key word. You have people who do very small business acquisitions, and then you have traditional private equity. We'll end on micro private equity at the end here. But private equity is where a team of usually general partners go raise money from limited partners, LPs, and they say, and the structure across private equity, hedge funds, and venture capital can many times look very similar, where you have general partners who are going to do the work and limited partners who give them the capital. And a common structure for these is called a 220. And so let's say if you and I are the GPs, we go out and raise $100 million. And if we have a 2 and 20, what that means is every year for all the money that's been wired. So if when you hear people say they've raised $100 million, it doesn't mean all of that money is wired into a bank account to be deployed. There's something called a capital call. And so you might say, all right, you've committed collectively $100 million, but we only need 20 million right now. And you send out the capital call and then the need to wire and whatever you've agreed upon. In the US, there's a document called a private placement memorandum, a PPM. And this is the document that says, like, here's all the rules about what we say we're going to invest in, but also what you promise to do to give us money. And you can go to jail in the US violating SEC and other rules if you do things that are outside of the PPM. And a lot of what we're seeing in crypto right now is the US using gotchas in some of these PPMs or whatever their investment documents were to say, oh, you broke the customer trust or promise. And so that can be, financial fines or otherwise. And so a lot of what's happening with CZ right now is based around some of these dynamics. So anyway, when you get that 2 and 20, what it's saying is for all the money that's actually wired in the bank account, every year you get to charge 2% of the total fee to cover your operating costs, to pay salaries, to get on airplanes, what have you. And then there's something called carry, and carry is the amount of profit that you get to participate in. So in a 2 and 20 with a 20% carry, the way it works is if we have $100 million fund, we deploy all of it. There's something usually called a preferred return. So let's say the preferred return is 5%. It's usually 5, 6, 8, maybe upwards of 10. Let's say it's 5%. That means that before the general partners get any of their money, the limited partners get $105 million. They're $100 million plus the $5 million on the 5 points. Once that happens, there's these other gotchas like hurdle rates and other things I won't get into, but keeping it simple. Then the future profits beyond that 105, 80% goes to the LPs, 20% goes to the general partners. And so if you and I are the general partners, we take that 20%, we split it up. And so we made whatever cash or income from the 2% during the fund.
Yeah.
And then the real money is on that back end on that carry. The really powerful thing for folks who are interested in this world, or taking what you already do and trying to figure out how it connects, is in many countries, this is how it works in the US, the carry is taxed as long-term capital gains. So it's taxed at a much lower basis than your regular income. So you want to try to get as wealthy as possible so you can defer as much of your compensation to the carry and take as little money as you can on the income, your salary. And it's not uncommon for some of these like super successful VCs or private equity folks to take salaries of $1. And because they don't want to be taxed, they just want the back end. So
makes sense.
So that's how almost all of these work. And so the private equity firm, let's say you and I have our new private equity firm, we've raised $100 million. Instead of investing that in public stocks like a hedge fund, or investing in a VC-backed startup, what we would do is to say, we're going to go look for companies that have been established. At the minimum, they've been around for a couple years, but many times you're buying companies that have been around 10, 20, 30 years. They have been around. And you have some thesis. You say that we're going to buy this company and it's dysfunctional. We're going to turn it around. We're going to buy this company and we are going to add more to it. Maybe you think you can do a better job marketing, or you think you can cut a deal for distribution, or you can remove some inefficiencies. And the goal is to buy an existing asset, increase either the top line revenue or the bottom line costs, so it becomes more profitable. Now, here's where private equity has gotten a bad rep over the years. In the 60s, there was a financial instrument that was created called the LBO, the leverage buyout. And what this allowed companies to do is to say, wait, hold on. Most of these companies that have been around for a long time have a credit rating that allows them to go get debt, right? And so somebody was like, hold on, we can just go convince the existing leadership team to take out a huge loan, and then we'll buy this company with debt using the credit score of the company. It's like a really weird kind of dysfunctional kind of piece. And then we'll write contracts that say, don't worry, CFO, CEO, COO. This is still in your best interest because we're going to give you a massive exit package. And that's where the term golden parachutes came from. Because what they would do is they would say, I think one of the big deals that kind of kicked this off was Revlon. And because while this instrument was created in the 60s, it was like the early 80s where this like went crazy. And what you're basically doing is taking a company that is hopefully healthy and you're loading it up with debt. Then you're taking some of the cash from that loan, you're giving it to the senior executives, and they leave. You replace it with new executives most of the time. You, as the private equity firm, take some of that money out as well. So you get cash right there, whether this deal works or not. And now the goal is to do all these improvements, and in 3 to 7 years, like you're flipping a house, sell the company to someone else. This was the playbook that happened many times. Now, the problem is sometimes you load up these companies with debt and they can't service the debt and they implode. Another thing that's happened quite often in private equity is in the process of trying to reduce these efficiencies, they kind of remove the humanity of all of this and they just start firing and laying off whole departments or different people. And there's like, this person's been working here 17 years, and then some spreadsheet person comes in and like, yeah, I don't know what this is. We got to get rid of these people. And like, it's just like all this trust and goodwill can get thrown out the door. And so all of that said, there are folks who, have done or attempted to do a much better job at how they run private equity. But the general playbook here is either you have money you're raising from LPs, limited partners. Yeah. You have debt that you're raising based upon the credit score, or you have your own cash, and you either are trying to turn it around and flip it in a short period of time, or you're buying it for the cash flow and you want to keep it forever. And so that's the umbrella of kind of private equity. What I do in kind of micro private equity, it's not just that my deal sizes are smaller. It's also that I don't need as many things to be true out of my control. I'm looking at a smaller universe of deals, not just from the revenue that it generates, or the profit that I'm paying for. I'll come back to that quickly. That's important. But I'm also looking for situations where the business isn't that complex. I don't need to ride the hype train, but I might be able to take something that is a new technology, incorporate it into that business, and you get what's called forced appreciation. So that's kind of the big levels. The last thing I'll say there, on that profitability piece, when you look at hedge funds, they trade on news and all sorts of other side bets and derivatives that have nothing to do with the underlying value of the stock. And you can make a ton of money doing that. Private startups who are VC backed are selling hopes and dreams. They're saying one day we'll be a monopoly and we'll go public, and trust us, you should give us money. Private equity, they typically, companies and deals are valued on the cash flow. So you'll hear free cash flow, you'll hear EBITDA, just kind of really simple financial terms on how much profit is being thrown off in cash every quarter or every year. And instead of valuing the company on how much money it makes, top line revenue, you're actually valuing the company on how much profit it generates, every period. And so every industry has a different range. And it's pretty easy to go figure out whatever business or industry you're interested in. A quick Google search will kind of give you the kind of current range. But many times it's going to be somewhere between 2 to 4, 2 to 5 times EBITDA or profit. And so that's where a lot of people, when they see businesses on the sell side, they think their business is worth a lot more than it really is. On the buy side, people realize they can buy really big companies sometimes for not a lot of cash. And so just a quick piece of arithmetic, let's say there's a company that has really poor profitability and the industry standard for profitability is 30%. But this company only makes 10% profit and it does $10 million a year, right? Well, at 10% profit, it means it throws off $1 million in cash. You're not going to pay a multiple on the $10 million. You pay a multiple on that million. And so let's say in this industry, the average is 2 to 4, you're going to pay 3 times the EBITDA, right? So now you buy this company that makes $10 million a year for $3 million, right? That's what you pay. What's really powerful about this, though, and this is where all these things and the backstory context I provided comes in, you can use loans, you can use debt, you can use LP money, you can use all sorts of things. You can even use seller financing. So the current owner of the asset will many times sell it to you, and you just pay, it's not like 30 years, it's usually, 5 years or some shorter period, but you can pay monthly or quarterly installments back to the person who owned the business because they just want to get out of the day-to-day operations, but they still want the cash flow. And so it's really important when you think about these different asset classes. For private equity, you're buying cash flow, you're not buying hopes and dreams or the revenue, but this becomes really powerful. And as you see holdcos, holding companies, and other things become more popular, you'll find many folks are kind of building private equity as the base to build their kind of family office and the way that they run their wealth. And then they use that cash to go invest in startups or invest in some other asset class. And I'm a big believer that, you don't probably want to get too complicated, but you can use private equity cash flow to buy the other things that you might want in your broader investment portfolio.
Interesting. Yeah. Thanks for the very detailed introduction about private equity.
Yeah. All right. So just a few more things about where I focus. I like to share this because there's so many angles where you can use your own personal experience and talent stack to go tackle some of these opportunities that, it really is boundless. And so I think it's helpful to kind of think about that. For me, I'm currently focusing on rolling up a set of productized services. So you think about, visual identity, graphics design, web development. These are not sophisticated, super sexy businesses, but I'm doing a roll up where I've acquired very small agencies and other things, and I'm putting them all in one package. And this is pretty common vehicle where, a private equity firm might come into a city and say, we're going to buy all the painting companies in this area. And then we're going to have a centralized marketing. And then that's how we're going to kind of get into this place. So I'm rolling up a set of productized services in the marketing space. That's one thing that I'm doing. The second is I have an active search fund where I'm looking to buy a business in the construction trades business. I just have a thesis that there's an opportunity for these more blue collar jobs. And I want to put more of a digital workflow on how marketing is run and how they operate. But a lot of these jobs, even in a down economy, they won't get digitized. These are folks who fix houses or service buildings and other types of things. And so that's currently where I'm spending most of my time. I always like to talk about this, what's not working in my business. I'll go through these quickly. I tried to hire big company operators, so people with like a big name on their resume. And I have very tiny teams on the companies that I own, and it was just a mismatch. They weren't used to doing the work themselves. They were used to kind of pointing, directing, and talking. I'm like, you got to roll your sleeves up, and that didn't work. Another was faceless go to market, so not humanizing the brand. Like I found I got to put the human in the brand. It can't just be so-and-so.com or such and such.eth and like here we go. I think you got to put the name there. And then I attempted, this is an experiment that did not work, but I learned a ton. There's an idea called service collectives where you find a group of freelancers and you give them cash and you take a profit share on helping them work better together. And there's just too many reasons for why people, the switching costs or the exit costs for someone to come in the collective and leave was just too fragile. And so I couldn't make that work. That's something to think about for anyone who's looking at DAOs or other types of kind of interesting organization structures. What is working is phantom shares. This is like part of my secret sauce. I love this. And this is where I give team members what looks like stock in the company. In the US, it's called phantom shares. It's a known legal instrument. And it's effectively a modernized way to think about profit sharing. And so it's like, if you do XYZ, you get, this bonus over and beyond your salary. And it's a way to align incentives and help people not quit. But why it's different than regular stock is if someone decides to leave the company, then that set of phantom shares reverts back to the shared pool, and then it can be allocated to the next employee. And so that's something that has been very useful.
So basically, they can only get the phantom share while they're working. Is that correct?
Correct. Yes. And so what you're trying to do is incentivize people to work there for years. You're not looking for folks who are trying to just kind of get the quick buck.
I see.
Yeah. And so that's not going to work for all types of businesses. There's some businesses where the natural tenure is going to be 1.5 years, 2-3 years. But some of these other businesses, like people, still work there 10, 15 years. And there's a great example of this, a company called Groundworks in San Diego. They were grossing over $800 million USD a year, fixing home foundations. And every market where they had a general manager, every one of their general managers who many of them had no college degree, they were working, very respectable blue collar jobs. They were all millionaires. And it was because of how they instituted, their version of these phantom shares. And so if you have a good kind of, employee and team culture and you pay people in an incentivized way, like you'd be surprised how much differently people will work. Not necessarily even harder. They will just map to the incentives. And I really like that as a tool. We've learned a lot there. The next is using real incentives on Copilot tools. I started telling folks, in the various companies, I said, hey, you all should use, GitHub Copilot, or you should use, ChatGPT Plus or whatever, and you can expense it. I don't care about the cost. And it was almost like there was like a stigma, like, I don't want people to know that I'm using this to do my job. And I kind of flipped it. I was like, no, I want to celebrate anyone who is using these tools. And so I just kind of formally put some incentives in place for people to actually use this. So, in reports or other types of things, there's a little tag that we use. And then folks, we celebrate or give them kudos when they're kind of using these tools.
Awesome. Yeah. And your objective for that is like to help them improve the productivity, right? Make them 5x,
Correct.
10x productive. Yeah.
Yeah. And the idea that using these tools, are not useful, I think is just obviously that's a silly idea. But if the person is already performing, giving that tool to somebody who does not know what they're doing, the tool's not going to be super useful. But to somebody who's already performing, they might get a 10, 20, 30% productivity lift without stressing themselves out. They don't have to work any harder. And it's like, that's like a $20 a month investment on my side. Like it's such a silly thing to even,
Yeah.
question when people are like, oh, you got to, like one of the things we're considering is moving all of our email and everything over to Microsoft 365. We have one team that does that, but everybody else is on Google. And the reason is, it's $35-ish plus a Microsoft 365 seat. So about 45, $50 per user to get access to their integrated Copilot suite. So you can like talk to your Excel file or talk to your document or what have you. And it's such a cheap price point to give every team member a superpower. I just think, it's, maybe it's not for everybody, but even if you have a small team and like it's just 3 people, you should, I believe, figure out like, how can you incorporate that in your workflow? And you get a lot of goodness for very low cost. Last piece here is just, I really prioritize writing. We work with async teams, people who are in Southeast Asia, folks who are in Germany, and to reduce the meeting culture, I have people write things down. Last slide here is just topics. I won't be able to focus on all of these, but as I said, I like to spend the last quarter of the year figuring out where am I going to dive deep. And I usually pick 1 or 2 themes. And so right now I'm looking at aging in style, just services around, aging population. Number 2, looking at business to government types of software products. I'm looking at prop tech, how we can use technology to make construction or related things around business building management, smarter, calling back to, kind of blockchain or ledger type, pieces. We know the basic ideas like, oh, could you do ledger based, property titles, or could you do things where the supply chain is better managed? There's so much opportunity in prop tech because most of the players today are just kind of simple web forms. There's no true kind of underlying tech there. And then the last 2 we've kind of talked about already. I'm very bullish on, building tools for solopreneurs. I think there's an opportunity to roll up things to help solopreneurs be more financially successful. And then we talked about virtual creators. And so anyway, I just thought I'd throw those up because it's sometimes I think helpful to see like, all right, what are other folks kind of considering as focus areas? And maybe it sparks another idea with some of your audience.
Yeah. For the first one, I'm quite curious for the aging. Actually, recently I met some people who are like into longevity. Does this have anything to do with that, longevity?
Yeah, and I call this category aging in style. The reason I really like that as a label is because aging in style is it's about life transition. So maybe you're an empty nester and your kids are out of the house, and so now you need to find a new place. Increasingly, folks don't want to go, just to some, nursing home where there's no lifestyle. These are people, you think about someone who's 65 or 70 who might be thinking about their next transition, or even someone in their 50s. These are people who grew up on the internet, right? Like they didn't grow up with smartphones and social media, but these are folks who grew up on the internet. These are not like, I don't know how to use tools. And so there's all sorts of pieces there on the physical life transition. But to your point, how you think about your body in this world is also super important. And I'm very, very bullish on some of these early breakthroughs that are starting to happen with these large language models and healthcare, because I think longevity and preventative care is going to plummet from a price tag standpoint. There's a company I invested in New York that does concierge medical services, kind of primary care treatment called Lanby. And what I like about the business is, it's for folks who want a high touch premium experience that says nothing's wrong right now, but why don't you check me out? And it's too expensive for something that everybody would have. But I believe we're going to get to a point where, for 29, 19, $10 US a month, you're going to have a expert in your hand that's going to help you with diet, with exercise, with mental wellness, like all these things. And so I'm super excited about that. And we'll kind of start to hopefully move away from this one size fits all approach to nutrition. And I think a big part of longevity is like we've been like putting the same hat on everybody. And if you have the right context on folks, I believe we're going to be able to realize like, oh, this is over here, your diet. This over here is a nutrient deficit. There's all these very obvious things. And the last thing I'll say about that is, if you look at pictures from like the 1970s, you'll see people smoking on airplanes. And it just sounds kind of ridiculous. There's like kids, there's babies. There's like it's so ridiculous. And you wouldn't do that. And I believe we're going to look at how we eat, how, the industrialization of food, and technology is going to reshape that. And it doesn't mean that, everybody will become a vegan or eat a plant-based product or what have you, but we're going to realize like the way we were treating our bodies was like super suboptimal. And I think there's so many opportunities in all sorts of ways. And, your focus on kind of looking at Web3 and other pieces, I think on all of these, it's also really interesting to think about the opportunities either for B2B or for core consumer services. And so relationships, money, housing, body, like these stand the test of time. It doesn't matter what the tech stack is. There's always someone who wants to pay to have those things solved. And so I get a lot of energy thinking about, all right, what's the right composition? And last thing, on these ideas, the reason I focus on themes is not because I'm trying to be like a hyper smart thesis-based investor. What I believe is attention is hard to get. And if you're going to figure out an engine to get people to pay attention to you, it should be on something that that group of customers can kind of go through a journey or a process together. And if you do all of that work, you want to have something where you can plug related products in that same pipeline. And you don't want to be building that pipeline for every product. And so I look at these themes as clusters where multiple products can fit in, and whoever in that space, my portfolio builds the best marketing machine, can provide distribution to other products or services that are related to that theme.
Okay, yeah, that makes sense. Yeah, I like how you're trying to think about like the synergies between the different companies that you're going to be investing in. Okay, cool. Awesome. Yeah. So let's go ahead and dive into some general discussion then about finance, private equity, maybe a little bit of Web3 also. First question I'm quite wondering about, I think you invest in like so many different type of business, right? I think I read on your website, you focusing on like digital goods, membership sites, and SaaS, software as a service. Could you also elaborate on the specific characteristic you look for when selecting these businesses to acquire? What makes a business ideal fit for your company, for your micro private equity?
So, when we started the conversation, I shared some of my background. One of the things that I was fortunate to do was invest on product strategy side in what's called entrepreneurship. So I worked at big companies, and many of them had really massive budgets where they had to allocate this capital every year. And, this is tens and tens of millions of dollars every year per leader, right? And so collectively we had, easily over $1 billion that we had to deploy every year. And that forces you to get the right hygiene and process in place. And so a lot of what I learned was through getting those reps. And then that led me to angel investing. Angel investing helped me at the interpersonal piece, because it's not just the spreadsheet. When you're doing entrepreneurship, you can assume all the workers are at your company. And so you're going to assume the talent is some minbar of quality. When you go invest in a startup, you don't know these humans. And so, most of the time, what I see as why an idea or a business fails is the team breaks up, the band breaks up. It's the wrong set of humans. They give up, they have tension, they have disagreement on strategy, like something like that. They pick the wrong market, or they don't move fast enough. And like, it's just that simple. Rarely is it like, oh, the product wasn't the right product. We didn't build the right feature. Like that's actually pretty easy to solve, but most folks are using that as the excuse for maybe something that's more systemically broken in the business. And so doing those angel investments, I learned a ton because I don't know where I'm at, 30 some odd, maybe close to 40 angel deals that I've done. You got to kiss a lot of frogs to be able to write that number of checks, right? Like you have to look at a
Yeah.
lot of deals because most of them just aren't investable, or
Mm.
maybe some are interesting, but you can't add a lot of value. I try not to
Mm.
invest in a business where if there was a tension or a friction point, one of the founders, may want to call me and ask a question. If I know nothing about that business, I'm probably not the best person to write that check, because as an angel, you're writing small checks, 25K to maybe $250,000, and so you don't come up with a lot of financial leverage. And so if you want to get in the best deals, people have to say like, oh, LaSean can give me feedback on my technical stack, or he can help me think about my go-to-market, or he can connect me with people in this industry. And so I always look for ways to add value, so people want to allow me in the deal, right? And so from entrepreneurship to angel investing, and then once I moved into micro PE, I've done 12 deals total. But half of those deals I almost say don't count because they were into these service collectives, and cash on cash, I didn't do bad on those investments, but like I just don't believe in that model, so I can't replicate it. So I call that a loss. But back to kind of my main focus, the businesses that are working where I've acquired full stakes, are these service businesses. And it's really interesting. I don't think any of them are ever going to get, really massive, but sometimes just repositioning, the company is very simple. So I bought this company that was building back-end heavy web applications. So they weren't doing like Webflow or WordPress or things like that. They were doing like, somebody needs like a custom automation, workflow that Zapier or Make or something isn't good enough for. And I ran into them because they were attached to a project that I got made aware of. And I looked at them and I got to know the woman who was running it. And I was like, what's your plan here? Like, it wasn't even like I was pitching them to buy the company, right? I was like, and she was like, I don't know. Like, we're actually thinking that we might not keep this thing going. I was like, it seems like it's going well. It's going just fine. And she said, yes, like we love writing code. We love the execution. We hate the sales process. And I just, I got off of that conversation. I was like, that's interesting. And less than a month later, I reached back out and said, hey, what if I could handle deal flow for you, for the first year and a half, and you just focused on, increasing the quality of the output and the talent on the team. And she was like, all right, that sounds interesting. We did a deal. The deal, it wasn't a ton of cash because, these service businesses don't get great multiples. And so I got in the deal relatively cheap. But the reposition I did is like, all right, I told her this beforehand, so I didn't do a bait and switch, but I said, we're not building any more of these back end, hard to sell products. You all are just going to build conversational applications, period. And the reason that's very helpful is a lot of these chatbots and LLM type experiences, they are more back end centric than many of today's application developers. So for your technical folks out there who may be doing like a reactive web stack, React, Angular, Svelte, what have you, or have an API connecting to a mobile app, like that's a known structure. And there's a ton of those devs out there. There's a ton of people who do freelance and agency work to go satisfy that. But there's a much smaller portion of people who do true back end work. In kind of Web3 and crypto, there's a reason that these Solidity developers, can make a lot of money, because, at least for a certain window of time, there wasn't that many of them. And you might see them like a Go or Rust developer moving into, to Solidity. But the point being is, all I did was say, you guys are going to just go make this other type of, or you're going to have this new offer. And then I just went through my LinkedIn and did a bunch of connections. And I'm like, okay, you have to go close the deal, but I'm just going to be the person who makes these connections. And that business is like growing like gangbusters. And to the point where we're trying to figure out, how do we productize this so we can actually move this down market? Because it's a fairly low ticket business in general.
Yeah.
Projects can be as cheap as 15 grand, and then they'll go to like maybe 120,000. So these aren't like super expensive projects, but they're not recurring, right? So there's no recurring revenue on
No.
these, other than like some small maintenance contracts. And so while that's great from a cash flow standpoint, what we're seeing is like there's all these patterns where like 3 of the 6 projects on a pipeline might be very similar. And so it's like, can we productize this to reduce the costs, deliver them faster, and just take on more projects? And so that's the thing that I really love in all of this is I've really started to kind of look through that lens. And then I have a couple of other deals where I wouldn't repeat them now, where they're like super random and they're just like, they don't have anything to do with anything. There's a deal where I was trying to do that didn't work. I'm glad it didn't work out. Where I was trying to buy a roof repair company. This speaks to my kind of local construction trades focus. And as I got to learn some of the employees, are like, these folks are all going to quit when we buy the company. And they're in private equity. There's something called also in VC. There's something called a key man clause, and this is where a man or woman is actually named in the contract. And you do an earnout. You say, I'm going to buy this company, but you don't get all your money on day one. You get it over 18 months, 36 months, sometimes as long as 48 months. And you say, if any of these people quit or any of these things happen, you get less money. And so it incentivizes folks to stay and to keep folks there. But like I said, I was fairly random when I was getting started. And as I said, as I shared that earlier slide, where I've now landed is to be more thesis driven. And the reason there is both kind of cognitively to add more value, find the right areas to focus, but 2, it just reduces your customer acquisition costs because you have a more consolidated acquisition channel because you're kind of selling the same set of things to the same group of people.
I see. Yeah, makes sense. One thing I'm quite curious about, so the life cycle of a typical startup founder, trying to go from 0 to maybe going public, I think typically from like 7 to 10 years, or could be more, right? Could be more, could be less, depend.
Yep.
So I'm curious for like, but you've been both an angel investor and also now in private equity. What's like the typical life cycle in terms of length of time for each angel investing?
So one of the reasons I got a bit disenfranchised with being an angel is because the time horizon is so long. Now, my first vintage, the first deals that I did, I just got connected to the right people. It wasn't that I was like any good, but I showed up with a good set of relationships, and those people got me in deals, and I'm like, that sounds good. I'll write a check. And the markups, and this is another thing to be careful with both VC and anything that is like, kind of pre-revenue or early stage, is you get these paper markups and it looks like, wow, this investment is crushing it. But until the money is wired in your bank account, like it doesn't matter what that number says. Those are just fake numbers for your ego. But it takes, typically 7 to 10 years for those things to pay off. Now, the duds will many times flare out in months. And then you'll have a handful that'll just truck along for 3-4 years. But any of the ones that are actually going to work, typically it's going to be a 7 to 10 year horizon. And so, let's say like a very, very crude, I won't give people financial advice, but if you were thinking about being an angel, min-bar is that you have to say, all right, I'm going to do 20 investments. And so if you say, I only have $100,000, it means you can't really write checks bigger than 2,500. Well, no, about half of that, right? And the reason is because you need pro rata, and you want to be able to reinvest in the winners as they raise further funding, right?
Okay, makes sense. Yeah.
And so I'm using 2 to 1 on pro rata as like basic math for the conversation's sake, but you get the point, right? And so if you write, those initial checks, and then you need to have some cash left over for the rest, you have to write really small checks. And that's psychologically, I think people are like, no, but this is the winner. But these businesses are so fragile, like many of them will just go to 0. And so that's like the min bar. To do it properly, I would say, angels that taught me, it's like you need about a couple $1 million, I think, to really play it properly, because you want one of them to really be life-changing if it hits financially. But you have to, I look at angel investing as like, you got to be willing for that to go to zero. And
Yeah.
so for most people, I just don't think they should be messing with it because, if I hear somebody who's like, oh, I got this new job offer at such and such, and but then I'm talking about this angel deal. I'm like, if you're still an employee on purpose, or an employee because you have to get money, like I'm not sure you should be being an angel unless you are in some type of pedigree group, right? If you work for a top five, big tech company, or you work at a fast growing startup yourself, and you have some inside information on which companies are going to grow. Like, there's always exceptions to this, but most people, I don't believe, should be investing as angels. But through that process, what I have learned is um, most of these deals are like I said, it's about the reps. You're going to get to the math and the interpersonal pieces very quickly just by doing reps. You'll be able to figure out, like, is this somebody I want to own part of their business, that I want to catch up with on Zooms, maybe grab dinner with in real life. And then number two, do their numbers make sense? I can look at typically when you get a data room, this is like a Dropbox or some folder of all the stuff for the company. Sometimes increasingly what people do now is they'll just give you CPA access to their bank, so you can read all their information, but you can't do any transactions. And then they'll give you access to their Stripe, and then you can just kind of see, like, are the payments in here or not, right?
Is
Some
it real?
international
Yeah.
folks use Paddle. And so it's really easy to go suss out if this business is working from, like, are these good leaders, and or these right financials. The bigger piece is like, can you actually add value here? And what I've learned is some of the deals that I've done, maybe they could have worked, but I just didn't set them up properly. I didn't set them up for success. And so the service collective idea I'll go back to, like, the reason those I think didn't work is I took a super hands-off approach. I wrote a document. I said, this is how I believe we can add value. I identified collectives that are already together doing service-based work. It's like, you all are already kind of servicing the same type of customers. And then we did a couple kickoff calls on video. And then I wrote a check to the entity they formed, and said, like, let me know how it goes. And it was just like, it's just a silly way to do business, right? But if that had worked, that would have been a magical scale process, right? So, like, I had to go
Yeah.
see if that was going to work. And so these aren't all things that are going to be slam dunks, but you just have to be honest with yourself on, are you showing up not just with the capital? Because again, I write very small checks, all things considered. There are massive PE firms like KKR and Apollo Group that they're doing multi-billion-dollar acquisitions. Carlyle, like, they're massive. And so if I show up with my little checkbook, I have to add additional value, and or I need to be looking in places for deals that are too tiny for them to bother.
Okay. Yeah. And can you quickly share with us the time horizon for micro private equity in terms of
Yeah.
years, a month? Yeah.
So there's two splits, right? Like I said, remember we talked about the LBO scenario. Typically, those are looking to reposition the company, even if it's small, even if it's micro private equity, in 3 to 7 years.
Okay.
But for permanent capital, where I play, it's all about cash on cash returns. And so my general rubric is, I'm looking for cash on cash return. Sometimes you hear return on equity as a financial metric. But for every dollar that I put in, I am trying to get that dollar, not adjusted for inflation, but I'm trying to get that dollar back in 18 months.
Okay.
And the beauty of that is, like, it forces me to, like, I look at a deal, and the deal could be amazing, but traditional private equity might say, we can sit in this deal for 10 years, or we'll just raise more debt. I'll look at that and say, there's no way for me to get cash on cash in less than 18 months. And so I pass on it quickly. But the reason I have that, that very aggressive structure is, I want to redeploy the capital. And when I invested in some independent feature films, and this is just one of those things where I got lucky, and I did it at a time where the streamers were looking for a lot of content, and I was able to place some of those projects. I would not do that again. Like, I realized how lucky I got. I was like, oh my goodness, that was like that was not good business at all. but I got lucky in the market. But what I learned through that process was, even though those returns are much smaller, if you can guarantee the distribution ahead of time, the cash on cash returns for those investments were crazy high, because you're getting your money back in 6 to 24 months versus your dollar into some of these other investment classes where it like legit can take 7 to 10 years. And
Yeah.
so when your capital's not locked up and you're turning it more quickly, you can just do more interesting things with that cash. And so from that, I was like, all right, there appears to be certain PE folks who, they're playing with other people's money. And so they're a bit more risky. And there's other folks who are investing their own money or family office money, for folks they're very close to. And I started saying, like, well, what do they do? And their rubric has been get the cash out relatively quickly. And then the other beauty of that is, as long as you stabilize that company, every dollar you're getting out of that business after that is just free money.
Yeah. Yeah, makes sense. Wow, I didn't know that the timeline for micro private equity is actually so fast. That's
Yes.
quite interesting. Yeah, and you mentioned permanent capital quite a few times. Can you share with us what's the advantages do you see in using permanent capital for micro private equity, and then how does this approach impact your ability to build a portfolio without relying on external fundraising?
So the downside is I can't look at as many deals, and my deals are smaller. The upside
Okay.
is, I have a fairly sophisticated approach to how I am tackling things that likely could scale up to a much larger fund. So I could likely be running a much larger fund with my same system, and there's always risks, but it would likely work out. But I'm applying a fairly sophisticated operational muscle to like a very small market. As a result, I can blow other people out of that space because like I can quickly find duds. I believe, my analysts and other folks, we have systems to spot the deals better than others. So that's an upside by me being in a small space. But at the core, what I love about permanent capital, you also hear people say permanent equity. Both of those are searches you might find on the internet. Is that it forces you to say what is in my control, and I'm a big believer of stoicism and kind of like focusing on what you can control in life, not what the world is projecting onto you. And some of this, I believe, is a market timing thing. So if you follow Ray Dalio or any of these folks who look at multi-decade waves of kind of capital markets, when money is cheap and easy to get, the leveraged debt-based private equity model is the way to go, period. But if you have a thesis that the world is going to be highly volatile and or debt is expensive, then permanent capital is the way to go. And when I say volatile, high interest rates or other types of things that the media covers is actually not a big deal. What's bad is interest rates that move a lot, the volatility. Like one year they're X and then another year they're, you can't have a 5-year plan if the
Yeah.
cost of capital is like bumping up and down, right? And so that's really important. Well, when you do deals with private capital and you don't need to exit, there's no bank that can call the loan, right?
Yeah.
This happens many times for investors. A quick side story: there was a big hotel in New York that had what's called mezzanine or bridge debt, and so there was the general partners who put the deal together. Then they raised money from limited partners, and then they had a loan from a bank. But there's an insertion loan there called a mezzanine bridge financing, and it was like a $4 million or so note. And for the underlying asset, we're talking real estate now, a big hotel building in New York, like that was like not a big part of the capital stack. And then it went to default. And in the U.S., you get to wipe out everybody who's behind you in the capital stack. And somebody found out, kind of got insider information that this thing was going in default, and they went and bought it out for almost double, like $7-8 million. Like, we'll buy this debt from you. And once they bought it, they then came back and said, you all are in default, and we are claiming the rest of the debt stack. And so they end up buying this hotel for less than 50 cents on the dollar. Like, it's a crazy, crazy deal. And these things happen quite often. And so when you're dealing with leveraged assets in private equity or real estate or what have you, when times get rough and you mispredict your cash flow, you can get screwed and just lose the whole asset. And there's a number of in every major city, from Thailand,
Yeah.
Sydney, Los Angeles, New York, London, every major city. Right now, there are people who own monster buildings that are underwater, and it's probably most acute in the U.S., where there are big cities like New York, San Francisco, where a person may have owned this building for years, and because of the repricing of the asset, the general partner who owns the building is going to get wiped out. They're going to walk away with no cash. So anyway, when debt is cheap, this is kind of the point. Leveraging up makes sense. When debt is not, you want to be decoupled from the capital markets, and permanent capital doesn't care if the interest rates go up or down. What you're really trying to figure out is this particular product or service, is it a price maker or a price taker? A price taker has to pay whatever the new price is when inflation moves. If it's a price maker, it sets the price. So, grain, raw materials, digital advertising, like Alphabet and Meta, they set the price of the ad. And so if you are in an environment where capital is going to be expensive or have high volatile, interest rates, you want to be decoupled and you want to have a product or a service that is a price maker. And like that, so that's kind of the piece. In 10 years, the economy might be like booming and we're back in like cheap debt, and my strategy won't be smart. And so I'm not preaching like this is the way. I'm saying, there's a seasonal time in our macroeconomic position. And during this window, if you have cash, you can get some really great deals and you can be fairly insulated to the drama that may happen around you.
Yeah. Well, thank you for sharing. I didn't know that. Yeah, I'm not a very strong finance guy. I have a pretty good background in finance, but I didn't know that there's so many interesting things you can do with like financial instrument and leverage. Yeah, thank you for sharing that. So when you buy a company like this from micro private equity, do you actually own the equities in this company, right? You like become an owner?
Well, you as the general partner or the lead on the PE fund, you get to decide what the deal structure is. For me, I buy the whole company. And so, and then I issue phantom shares back to any of the operators or folks who stay on the team.
I see. Makes sense. Have you ever invested in any Web3 companies?
Not yet, but like I said, I'm very bullish on the space. What I'm really trying to force, this is why I started the conversation. Many times people want to build the product, go figure out how to sell it, and then say like, well, who's the right customer? And the deals that I've been exposed to, there's a great white paper, there's a great kind of technology story, and I'm like, all right, define your market and tell me how you're going to go to market, how you're going to sell. And so that's where I can get more educated on getting more deal flow. But simple things. If someone says, "Hey, we have this consumer product, and all these people are going to use it. Here's our projections," but then I go use it, and like the wallet workflow is all clumsy. I'm like, no, this is not ready for prime time. And so these are some of the things that I have pretty good product instincts, but I haven't seen enough deals to kind of see something that would make me interested. But I remain interested in the space.
Yeah, agree. No, I completely agree. I've talked to so many Web3 co-founders, and I think it's me as like a native Web3 person. Yeah, there's a lot of UI UX need to be improved in order to bring more people into the Web3 world and space. But also Web3 is also quite applicable for. I think looking back at like your 2024 list, right, of the 5 ideas. I think prop tech for one, and the other one is virtual creators. I'm for sure those who can be easily easily
100%.
leverage Web3 technology. Yeah, exactly. Yeah, so then which brings me to the next question. I'm curious, like what is your like general opinion about Web3 crypto space, like in general from an external perspective, outside there?
Yeah, well, I've been in technology for a while, and maybe that blinds me on certain opportunities, but I think where it's useful is I really kind of look at these general inflections I've seen in the past, the Web 1.0, the Web 2.0, the mobile inflection. I worked in big tech at Microsoft for quite a while, and one of the jobs I had there was working on product strategy for apps for this device called HoloLens, and that was Microsoft's previous generation attempt at what Apple is shipping as their Vision Pro. And so it's a computer on your face, and at all these inflection points, there was something changing, about the technology or consumer behavior or both, that says like, all right, the behavior is changing, the regulatory environment is changing, or the tech is changing. I'm always looking for one or more of those levers to be moving. And I want to have a point of view that is contrarian to everyone else. So if everyone is like, this is just going to be a slam dunk, I'm less interested in investing in that. I want to have a point of view that people think something's not going to work. I think it's going to work. Everybody think it's going to happen a certain way. I think it's going to happen the other way. And if I find myself in consensus on the future, I'm happy to be a consumer of the news to see how that goes, but I probably want to invest in it, because rarely is in the very early stages, is that capital the smart capital. Now, once it catches fire and escape velocity, then you want to get on that wave, because you kind of can't lose when it's working, right? But in the very early days, it's kind of tricky there. So I say that to say, when I look at Web3 and the buckets of those, I see a very similar pattern of the technology is quite interesting, but the folks who understand the tech are discounting how much convenience customers are going to require. They're not going to do all the hoops. I mean, I had and this is one of those bad stories that many people had, but I had a old GPU that had a couple Bitcoin on it. And I was formatting the drive, and this was like a long time ago. And they were maybe like $80-$90. And I was like, I couldn't, there's something wrong with, it wasn't the BIOS, but I couldn't get this thing to read. And so I had to take it around to other computers. And finally I was like, man, I'm not trying to like read this drive for $200 or whatever they were worth at the time, right? That's like 70 grand or something right now, right?
For sure.
And so
allowed to be worth a lot,
so fortunately it wasn't like some crazy number, but the point is, like, I was engaged in the space and it just felt like it was too much of a headache. So the casual person, where someone's like, I'm going to sell some type of influencer trading card or whatever, if it's not single button or two screen taps, it's probably the wrong interface. And I don't know if LLMs or other types of modalities are going to reshape that. We'll see. But I feel what's mostly broken is people don't really speak to the customer demands. I worked at another tech company where there was a edict that said, don't violate the customer's needs and wants for what they called CPS. And it stood for convenience, price, and selection. And it's like, you can have a fourth, fifth, sixth benefit, but if you violate convenience, price, or the perception of selection, i.e. product choice, you're probably not going to have a successful product. And I think a lot of times folks are really, really underestimating both the convenience factor, that's the UI UX piece that we're talking about, but also on the price. There has to be some signal on, people are pretty price sensitive nowadays. And so if you look at a basic, value equation, value equals benefits minus cost, people want those benefits to be clearly mathematical, and they want intangibles on top of it, right? And so, people, might say, all right, like right now I'm using wired headphones. They work very well. But if I wanted to socially signal, I might go get some, noise canceling AirPods to show everyone like, oh, I have the nice ones, right? And you don't really know how to value that social capital, that intangible. And so what we tend to do is look for surplus. We want to make the math not precise, but it's so obvious that the benefits outweigh the cost that you want to make a purchasing decision. And I think one of the struggles I see with many Web3 projects is they don't make that super obvious, right? In the early days of Google, when Google, I'm forgetting the team, it was a very small team inside of Google that figured out how to do paid ads and start monetizing search. They would just go to the agencies, and these were companies that would do the media buys on behalf of the brands. and they're like, it's 10 cents on the dollar, like it's 10 cents the cost, with 10 times better um, efficacy. It's like, who's not going to try that? Right. And then once you try it, if it actually works, and it's like, oh, it's not actually 10 times better, it's 5 times better. But guess what? You're going to keep using it at that point because it's 5 times better. And this is what I think folks have to really internalize. And sometimes it might already be true, but you don't have, I'm forgetting the guy's name, but he's the chief strategy officer over at Intercom. He uses this term, problem story fit. And I really like it because it's like, sometimes you have the right solution, but you're telling the wrong story. And so people are like, I don't know what you're talking about. I don't want to give you money. And so these things are less about writing code or hopping in Figma and designing some screen, and more so about the psychology of your customer. And, you know, I don't have the answer on how to solve those things, but the root cause is to me pretty obvious.
Interesting. Yeah, thank you. Wow, that's very interesting opinion. I like the contrarian opinion. I'm also looking for like something contrarian as well, because I don't really want to go with the flow. That's why I also like the external perspective as well.
Yeah.
Yeah, but like I said, yeah, there's still a lot of work to be done in the Web3 world. But I think Web3 has evolved a lot since the day of when you lost your 2 Bitcoin with the hardware.
Yes.
Yeah, I think that was at least like what 8 years ago, right?
Yeah, it was a very long time ago. Maybe longer than
I
that.
think Web3 has evolved quite a lot since then, but it still hasn't reached a point where the UI UX is optimal yet. I would say we're still pretty far away from it, but I think we'll get there. It just takes some time.
I agree.
Usually, I like to compare it to like the early days of the 2000, of the Web2, right, when people were just jumping on like everything online and just going crazy. Yeah, so I think we
and
have similar.
That's why I was talking about those various inflection points of technology. I think when people say like, "Oh, this thing is going to work," and they're folks are off to the next shiny toy. You could see it when here in the States, folks would be pitching Amazon stores, FBAs fulfilled by Amazon stores. And then when those basically people were just taking the Alibaba product and then doing paid search on Amazon. Like it wasn't a real business. And then when that fumbled, they went to social media agencies. They're like, okay, now social media marketing agencies, like I'm the guru. When that started to collapse, the next thing in this kind of the current wave, it's AI automation agency. And all of these things are valuable, right? It's not like, those things are not businesses, but at a certain point, the barrier becomes so low for somebody to be in this business. You have to be amazing to make that work. And meanwhile, as people are chasing these trends, the thing they left is now it doesn't have the spotlight. That's the time to me where you go get it. And so, I kind of look through these transitions where it's like, when, is the media not covering it quite the same? Are all the hustle bros like moving on to something else? If so, that might be the time to really kind of dig in on that tech if you believe in it, and kind of build something magical, because typically these things do go through that trough of disillusionment where it kind of dips before it comes back up. And the hard part in all of this is you got to make bets with the minutes in your life. And you don't know how long that dip will be. And for some bets, they will never come back. And so the conviction as an entrepreneur is to not just see the future, but get the timing right. And the folks who do can change their life.
Yeah, certainly. Just three more questions here from my side. One of them would be my show signature question. So I'm curious, from an external perspective, right? How can for Web3 companies in general, how can Web3 company and Web3 builders, what can they do to onboard 1 billion people into Web3?
There's an image that I saw, and I don't know who to give credit to, but it was an image that showed how people were using Web 1.0. And it had a bunch of categories: news, weather, productivity, finance. Like you looked at everything, and then they took that same taxonomy and they applied it to Web 2. Then they applied it to mobile. It was very interesting because you look at it, it's like, oh, a lot of these human behaviors are still the same. And many of those businesses were not good businesses then, and they're still not good businesses now, right? People keep trying to figure out how to do news, and news is very hard to scale and do it profitably. And so from an outsider who's not, I cursory, I have a technical understanding of many of the pieces, but I don't really know the industry. So there's many things that, someone may yell at the screen and say, "Oh, LaSean, we got that solved 3 years ago." But my perspective is figure out one of those consistent human behaviors and really rally around it and make it so simple to onboard that it almost, it feels like obvious that I would just do this, right? And examples are, things like credit cards. One of the reasons that some of these biggest companies, whether it's a Netflix or an Amazon or Alibaba, WeChat, these companies have these massive kind of moats. It's just because they have a payment instrument on file. Right? And it's like, once you get that credit card, you can do all sorts of things with it. Think about Uber or Grab. Like, once you have the credit card for the car, you can go sell the food delivery. And so my take is there's probably something very simple from a strategic standpoint where, like, the one metric that matters is the equivalent of how many active payment instruments do you have on file. And then the call to action for the consumer is some very, very low barrier action that they take. That's a no-brainer. And instead of saying this thing can do everything, kind of say, hey, here's this one thing that you may not even know Web3 is behind it. It's just obvious that this is the best way to approach that problem, and use that to drive the initial adoption. And then those other scenarios that we see in almost every phase or wave of these technologies, those other things can show up. But I think it's really hard to kind of build the whole thing all at once, because I started saying that people want the convenience. A more pejorative way to say it is like, people are just lazy, and they're not going to go jump through all these hoops for this thing that they're not excited about the same way you might be.
Yeah, and I completely agree. Yeah, I think we need to create some more intuitive, like you said, like one-click onboarding, or even one-click, simple action for users to make it easier for them. So yeah, still have quite a lot of work to do in Web3 for sure. You seem like a very experienced person. You invested in a lot of company. Do you have any advice to share for people who want to begin their own company, or people who want to get into private equity?
I would say probably don't do it.
Okay.
So two things. If you want to start a company, I think you got to be up for some pain, especially on the first or second time around. And this is why, when I hear people are like, I want to go swing for the fences, I want to do a moonshot, I'm going to do VC-backed startup, I'm going to go make real money. I don't have a problem with that, but most cases, it's not going to be your first or second attempt that works. And so you got to figure out, are you committing to a 10 to 20 year journey as a startup founder? And if so, then, like, if you stick to it, build the right relationships, follow these processes, like, it can work and it can be transformative, generational wealth that you can create. But most people are going to quit at some point, or they're going to take on life responsibilities that put them at a disadvantage for who they're competing against. And so I think most people shouldn't do it. If you go from a really risk-adjusted basis, your best bet is, especially if you have pedigree, is to go and get a job at a like the largest multinational corporations. Not like, oh, I work at a big company. Like, take the top 20 companies in the world, or perhaps the top 20 in your industry, and go get a job there. And if that company is part of the public, the capital markets and public equity space, it's going to be kind of manipulated through this whole process, and its value is going to increase. And so if you get restricted stock units, RSUs or some type of stock compensation, your ability to extract value out of that corporation as an employee is probably the best way to make money predictably with low risk. And your switching cost to go to the next company after you get the first one is very easy. I've now worked at some very large companies. For me to have a failed startup and then get back on LinkedIn and say, hey, anybody want to give me a job? Like, it's very easy to do because of those stamps. And so I think most people should consider that path first. And then if you're really built for the startup game, something's going to tell you, like, that ain't it. I don't want to work in that place. I don't want to hang out with those people. I have a dream that's bigger. I want to move without permission. Like there's something else that's going to tell you, I got to do this in a different way. And then you have to ask yourself, am I willing to pay the cost, the pain to go down the less attractive path? And through that lens, I think then you show up ready to really get to work as an entrepreneur. But I wouldn't romanticize it or say, is this the best way to make money? Now, on the private equity side, and all of the, I talked about the three kind of paths on hedge fund, PE, and VC. All three of those have people who come through banking or finance backgrounds and just really understand, hedge funds or private equity, and they can be very successful. Those types of jobs typically are high intensity, high volume hours per week. And if you can work in that environment, you likely will be successful when you move to private equity. So, people who work in investment banking or really any type of high-end finance, you probably work a lot. And when you see the hours in PE, you're like, oh, this is actually something I can deal with because you're not overwhelmed by the work pace. Other folks, maybe if you've been in the military or you play professional sports, these might be other indicators that you have what it takes to kind of work at that pace. But if you've never worked at that pace where mentally you need to have that level of output for like long sustained periods of time, most folks, they'll call it being burnt out, but they're just, their personality type or other reasons, they might not be built for it. And I would argue many of those places are dysfunctional. So I'm not saying like this is the right way to do it. Like you shouldn't be working this way in a lot of cases. But you are likely going to be better prepared to go into this line of work if you're built to have high, I call it productivity density. You're able to put out a lot of intellectual capacity for a very sustained period of time without getting burnt out or feeling emotionally drained at the end of the day. And so if that is something that's interesting, going down the traditional path of learning finance or what have you and coming into the space is one way. The other way is you just become an operator. And after you run your businesses, whether they worked or they didn't work, you take all those lessons, you take the relationships you've built, and then you either have the cash you've made on your own way, or you take high net worth individuals you've met along the way, convince them to give you money, and then you go give it a shot. And the folks who can stick around, you can get quite financially successful on this path, because really what you're doing is you're aggregating the startup model. So instead of working for one startup, you are getting the benefits of having multiple startup journeys or companies all accruing value to you at the same time. And that's just crazy leverage, because if you think about what I started with, I talk about my companies are all focused on some type of audience building and some type of automation first angle. And it's not accidental that these are elements, if you look at the Naval Ravikant 4 points of leverage, it's human capital, it is financial capital, it's media, and it's code. These types of businesses, you can not just get one or two, you can get 3 or 4 compounding on each other. And that's like crazy money when you get that right. And so again, I'm not saying my way is the way, the best way. There's plenty of people in my circle who make way more money than I do, but I found a path that's pretty predictable. And I just enjoy the work. And so I think the upside is this is a lane, if it were to suit your personality, that can, address your money concerns, but hopefully it's still work you could also enjoy.
Yeah, certainly. I like how you always list the pros and cons so people can actually see both sides of the equation. Yeah, I think that'd be helpful. And I completely agree. I think you want to work for something that you actually enjoy, right? Yeah. Don't want to do something that you don't enjoy, because I don't think that will last very long. Final question. Where can people follow you? Feel free to share any social media handles, websites, or any other site you want to share.
Yeah, I'm really simple. So when I share my information, it's really interesting. I like to tell folks that I am not here to, I don't have anything to sell folks unless they are an experienced operator and they want to potentially work and lead one of my companies. And so I might be trying to sell them a job to come and, run one of my businesses. But if somebody has a business for sale that's in that range, that I talked about, either price or profitability, that's on any of the focus areas I talked about, that's a reason to reach out. But that's a very small window. And so these conversations, in the past have not been, about deal flow. What I do find very powerful is when folks are like, hey, I'm early in my journey, or I have some follow-up questions or what have you. I love to do free coaching and mentoring. And so, the reason I'll give out my information is for folks who want to follow up for a free, 15, 25-minute call, because I'm happy to give someone answers to maybe some specific things. I don't know all the answers. Don't listen to me verbatim, but, there are reasons where I can maybe help somebody. But what I get out of it is both the energy of somebody being focused and driven, but also they're going to have perspective, and I'm going to ask questions, and I'm going to pattern match, and I'm going to start finding new opportunities from talking to them. And so that's the why. And I always like to preface that, because sometimes people give their information. It's like, well, why would I contact this person? That's the why. You can reach me 2 places. LinkedIn, it's my full name, LaSean Smith, LaSean Smith. You can also reach me on our group email. It's at grow@CAGR.com. That's GROW@CAGR.com.
Awesome. Yeah. So I'll make sure to put that in the show notes for people who may be interested in contacting you. Once again, thank you very much for your time today. It's been really
great to
fun
hang out
and enjoyable talking with you today. Yeah, it's been awesome. And we are back to my studio. What do you guys think about this 13th episode of Colors of Web3 and Entrepreneurship? Well, for me, I really enjoyed talking to LaSean Smith. He had a very interesting perspective on various topics, including finance, private equity, entrepreneurship, and especially Web3 from an outsider perspective. Please leave a comment below. Let me know what you think about this episode. In the future, majority of episodes will still be Web3 related, but I will still talk to people outside of Web3 and into entrepreneurship. So for the next episode, we'll be back to the Web3 world. I'll be talking to Balao Khan, who is the CPO at ZKX.com, a multi-chain decentralized exchange powered by ZKP. It's a very interesting conversation you don't want to miss. Thank you for listening, and see you next time.